Hey guys, Toby Mathis here, and today we're going to talk about the top 5 tax-free investments. It's not what you think. It's going to be a little bit different than what a lot of folks are out there talking because, well, I'm a tax attorney and I look at things differently. So number one, let's just say that we're going to do 5. We're going to do number one is the easiest way to have a tax-free investment is never to sell. And the reason I say that is because you are not taxed on most investments, on like, for example, in individual stocks. If you buy real estate, you're not taxed on it until you actually sell it, or if you buy options until there's an expiration, or until it's called, or until something is done with it. So that's what you'll always look at. It's like, what is a tax-free investment? Number one. And I'll use the example of Elon Musk and his billions of dollars in Tesla, SpaceX, and everything else. He just doesn't sell it. So he borrows against it. So when they look at his tax return, they say he's a billionaire and he doesn't pay any taxes. It's because there's no taxable transaction. Beware, because most brokers want you to churn. The whole thing about, like, for example, in the stock market is they want you to be active, right? Hey, let's buy and sell. Let's buy this. Hey, it dipped. Let's buy it. And then if it comes back up, let's sell it. Resist that temptation, because that's a tax nightmare. If you want tax-free investments in the stock market, just buy companies and hold on to them. There is one exception, which is companies that are paying dividends. That income, dividends are just, they're paying you a portion of the profit. That dividend is going to be paid out to you, and it's going to be paid out at something called long-term capital gains rates. So if you're an ordinary American, chances are you're in the 0% tax category. If you're married filing jointly and you're below 80,000, for example, you're the average American, you're actually a little bit above the average American. You are going to not pay any tax on that anyway, which is great. Again, tax-free investment. Worst case scenario is taxes long-term capital gains, which is 15 or 20%, depending on how much money you make. If you're over 500,000, I believe you're going to be in the 20% plus. Now, how do we combat that? Is option number 2. Here's the next tax-free investment, which is exempt entities. And this is a broad category. When I say exempt entities, which means they do not pay tax now, they may never pay tax. And an example of that, of an entity that if you buy investments inside of it and pay it out to yourself, you'll never pay tax, is like a Roth IRA. That's your prime example. So if taxpayer A is a 21-year-old going through college, who's paying 0 in tax, makes $10,000, and they put 5 of it into their Roth IRA, they didn't pay any tax on that, federal income tax at least. And so it goes in to, so that money goes in there. And then if you take that $5,000 and you invest in any number of companies' investments, whether it be ETFs, mutual funds, which I do not like, but you invest in those types of things, then as they grow, and even if they're kicking off dividends, there's no tax. And when it pays it out to you, you never pay a tax. A traditional IRA is where you get a tax deduction to put it in. So, so I am, not only is it tax-free, the growth inside that thing, but I'm getting a deduction in the very beginning. Now, the problem with the traditional IRA is that it's tax deferred. So you're going to pay tax on it when you get over 72, for example. They force you to take out what's essentially about 3 or 4% a year as a required minimum distribution, and you'll pay tax then. But in the meantime, you get all this growth. You could have 40, 50 years tax-free investing. Now, the business side of a traditional IRA, a business-sponsored account, is called a 401k. And that's where a business is sponsoring it, putting money into the 401k. You're deferring, again, taking a tax deduction for the most part into a traditional 401k. There is a Roth 401k component where you can put tax-free up to, I think it would be $19,500 if you are under 50. If you're over, you get another chunk of a makeup amount. I think it's 6,500. So you can put like 26,000 in there. You don't get a tax deduction for it, but you'll never pay tax on that money again. Last area is an HSA, health savings account, where you get a tax deduction to put money into the HSA, and then you could just let it grow. And that money is being used for medical expenses until you reach a threshold age where then you could just take it out for any purpose. But the growth is going to be tax-free. You get a tax deduction to go in there. You won't pay tax if it's used for health accounts. So that's a great tax-free vehicle. Now, a little bit easier one, number 3, is actual tax-free funds, and I'm going to say ETFs, although there are mutual funds. And what it is it's investing in a specific type of bond or an investment that is tax-free. So for example, this will be number 4, is municipal bonds that are tax-free muni bonds. An ETF might buy a whole bunch of those. And so you could just buy a tax-free ETF, or you could just drop down and say, hey, there's an individual muni bond. I just want to buy those directly and they're tax-free, which means it's basically a loan to a government entity, a municipality, and it's paying you back and you don't have to pay tax on that. That's how they're incentivizing you to do it. They're not the greatest payouts, but they are tax-free. So if you're in retirement and you don't want to mess with your income level because it could make Social Security taxable, you might do tax-free muni bonds. A lot of people do that and say, hey, if we're going to do anything, let's do it to where it won't harm us in any other way. The last area where that is tax-free, number 5, is index universal life. It's insurance, and it's life insurance that has a cash value. And the reason that this is important is because the cash value is tax-free under Section 7702 of the Internal Revenue Code. So it goes like this. I put $1,000 into my insurance policy. Let's say 100 of that's going to cover the cost of the actual insurance. So it's called death benefit. So let's say 100 of it's going to cover the cost of the insurance, and $900. So I put $1,000 and $900 in. It's going into this tax-free account that can invest in the market. Usually they're buying options on the market. And here's what's cool about an index universal life. You can have a policy where you can't lose money in that cash value. In other words, it's investing in the market, but if the market drops 30%, you lose 0. It's because they buy options on it. So there's a cost of the option. But on the same token, you're capped. So if the market goes up 20%, you may only get 13%. Like there may be a cap, or 11%, or whatever it is. So you're in the market, it's tax-free, you never pay tax on it. And then the obvious question is, well, how do I get money out? They do what's called a loan out of the policy. So you do a policy loan out of my cash value. This is very, very common, especially in executive compensation plans. In fact, I think Jim Harbaugh's got one of the largest ones. That's the coach of Michigan, just this massive tens of millions of dollars in this IUL that they're putting in there for him so that he can access that money tax-free when he's retired. Because it doesn't matter if I'm making $1 million a year, if I borrow $1 million out of my policy, it's tax-free. So it's absolutely effective tool. People call it infinite banking or bank on yourself and all this stuff. I just call it Section 7702 because that's the Internal Revenue Code provision that says these types of policies can have a big chunk of it going into cash. And then if you abuse it, like you put too much into cash, I put $1 into insurance and 99% of it goes into cash value, then it's called a MEC and it makes it taxable. I'm not going to get into all that. But what it is if you follow the rules, there's a good chunk of money there for you if you need it, because you don't have to take the money out. You don't have to borrow it if you need it. And this is great for folks, when I think of elder folks that are dealing with long-term care, a loved one with dementia, whatever. You're able to borrow from that policy if needed. You don't have a taxable transaction. It doesn't make your Social Security taxable. It doesn't push you into a higher bracket. It's tax-free, whether if you need it or not. And then you say, what about the interest rate? It's usually a wash, or it's a really low amount. If you could have a wash loan where, hey, I just don't get any growth on that money, but I borrowed it, I don't pay any interest. Or you could have it where it loans it to you at a lower rate. Like, hey, let's say right now it's maybe 3 or 4% and the market's going up at 13. You actually still make money on the money that you borrowed. It's kind of weird, but it's because the investment versus the loan are two different things. So those are your 5. I'll just repeat them just to be redundant. Number 1 is do not sell. If you do not sell your securities, your real estate, or whatever, you do not pay tax on it. Number 2 is use an exempt entity like a 401k, an IRA, HSA. You can even throw a 501c3 in there. Number 3 is an exempt ETF. I'm going to ignore mutual funds because I don't like the cost on them, but exempt ETF is super cheap. And it's basically a big basket of tax-free of like muni bonds. Number 4 is the actual muni bond. Hey, I want to buy a specific one. That's great. Or a couple or whatever it is versus a big basket of them. And then number 5 is IULs, Indexed Universal Life. And that's your 5 top tax-free investments. Hey, if you like this, please subscribe, share it with your friends, and like us as well. That would be great. We love putting this content out, or I love putting the content out, but our organization loves doing education. And if you're willing to share it, that's great. It gets the information out to more people to help more people. Thank you.